Hello and welcome back to the podcast. Okay, before I get started today, I want you guys, I just did a podcast this week for on the Farming Without the Bank podcast, and I'm talking about three types of interest: simple, compounding, and uninterrupted compounding, and which one is more powerful. Go there. Run there after you've listened to this and listen to that one because it's going to answer a lot of questions about why we use whole life insurance. Okay, with that being said, let's talk about paid up additions today. And a lot of people recently have been talking a lot about this. I haven't ever really talked about this, but it's come up a lot. So let's talk about it. When we talk about correctly structuring a policy for the infinite banking concept, we're putting a paid up additions rider on that policy. That paid up additions rider is not something that every single company offers. And so you have to make sure the company offers it as a rider. Some companies and most companies that are mutual will pay you your dividends in paid up additional insurance. And so you'll see it in your statement, but that's not what I'm talking about. I'm talking about a rider that gets put onto the policy that is a paid up additions rider. Some people call it different things, but it's buying paid up additional insurance. And some people will say, well, what is that, Mary Jo? So when we buy whole life insurance, when we buy just the base, it's called base premium. When we put money just to base premium, buying whole life death benefit, the life insurance company says, okay, you want to buy a whole life policy of, let's say, $500,000. I'm going to charge you a little bit for that cost of insurance every single year over your lifetime. That's going to be your premium. Now, I'm making this very general, but that's going to be your premium. So you're paying that over your lifetime. So you have to pay that every single year. And then death benefit grows in whole life, but it's growing because dividends are going back in to buy more paid up additional insurance. So now we put a PUA rider on the policy, and that PUA rider is paid up additional insurance. So what that means is it's instantly paid up. If we gave them $1, they gave us X amount of dollars, a death benefit, and it's paid for. We're not paying over our lifetime for that amount of death benefit. We're not prolonging the cost of that. Whatever the cost of that dollar of death benefit was today, that's what we paid for it. So let's say that, we have $1 of paid up additional insurance. We've put $1 into the PUA rider, but that bought us, $2 a death benefit. Fantastic. That it's going to buy whatever it costs today. It doesn't stretch it out over our lifetime like the whole life portion of the policy does. And so what Nelson found is that if he put this rider on and we bought paid up additional insurance, very quickly, that money then it created cash value faster in the policy. And so a lot of people will say, well, I can go to XYZ company. I'm not going to name any names, but I can go to XYZ company and yeah, they must have put a paid up additions rider on that policy because I have cash value very quickly. Well, when I look at the policy, there's no paid up additions rider on that policy. They just did a 10-pay policy or a 20-pay or a paid up at 65. What they did is they shortened the length of how long you're going to pay your premiums so it builds cash value faster. So it looks like there might be a paid up additions rider on there, but there's not. And so what Nelson is talking about, what I do the majority of the time, is I want you to pay premium till you're 121. Yes, until you're 121, because that policy compounds. Go to the Farming Without the Bank podcast, and we're going to talk about that over there today. And so uninterrupted compound interest is massive. Once that starts, how much can we get in there? We want to get in as much as we possibly can. And so I don't want to ever stop paying premium. I'm going to pay premium till the day I die. Unless something happens that I can't, I am going to pay premium till the day that I die. When we do a 20 pay policy, that means we pay for 20 years and we're done. When we do a 10 pay policy, we pay for 10 years and we're done. When we pay up at 65, it means we're only paying premium till 65 and then we're done. And so those policies tend to look like they're creating cash value faster. And they do because you're not paying premium forever. But when you get past year 10, 20, and 65, now all of a sudden, where are we going to put our money? Because you don't stop having money just because you're 10 years into something or 20 years into something. So now where are we going to put our money? And we want to be able to continue to pay that premium. And we want to be able to continue to get paid up additional insurance in so that we can have more money compounding, right? So when you are buying a policy, where is their paid up additional insurance rider? If they don't have that rider and they just shorten the policy to try to duplicate what I have in the book, that's not the answer, my friends. That's not the answer. They do not understand what they are doing, or their company does not have a paid up additions insurance rider. And they probably don't know that either. They maybe don't even know what that is. And so finding somebody that really understands how to do this is extremely important. I mean, I say that all the time, but I'm not joking about it because there are so many things that need to be thought about. I had a client a couple of weeks ago that just said, "Oh my gosh, Mary Jo, like, I hope you're going to be here to help." And I think I talked about this on the last podcast. I hope that you're going to be here to help because there is so much to know, and there is so much to know. And so when we go to somebody that doesn't do this every single day and they're just trying to spit out the same numbers, they don't even know how the numbers are being derived. They don't know how the insurance works. They don't know how to utilize it. They just don't know a whole lot of stuff. And so if you are willing to make sure that that is important to you and that your, money is important to you, then be willing to meet with me over Zoom or somebody else that understands what they're talking about. That is what the paid up additions insurance is. Not a lot of people are talking about that in this industry and the power of it and how it works and all that good stuff. So I wanted to share that. If you have comments, questions, concerns, you know where I am at. Email me, maryjo@withoutthebank.com, or you can go to themjhotline.com. If you have not gotten the Life Without the Bank book yet, or Farming Without the Bank, or Becoming Your Own Banker, then go to withoutthebank.com and get them, because what you waiting for? All right, guys, let me know if you need me. Otherwise, you have a fantastic rest of your day.